Hello, my name is Joe Hoyle, speaking to you today from the University of Richmond, and we're starting now on Chapter 13 of your financial accounting textbook. A major change occurs here in Chapter 13. You need to be aware of that. In the past few chapters, we have looked carefully at assets, accounts receivable, inventory, buildings and equipment, intangible assets such as goodwill or patents, and investments. Here in Chapter 13, we switch to the liability side of the balance sheet. As we have discussed in earlier chapters, a liability is a debt. A liability is a claim that someone has to the assets of a company. Therefore, the reporting of liabilities is considered very essential in determining the financial health and future prospects of an organization. A lot of time and energy goes into making sure that the portrait painted of liabilities is one that an outside decision maker can really understand. So we're going to introduce you in this chapter and in the next couple of chapters to the financial reporting according to U.S. GAAP of liabilities. In this chapter, we begin with current liabilities. Current liabilities are typically liabilities that must be paid within 1 year. So if you have a salary payable, a rent payable, interest payable, or the like, those are frequently recorded as current liabilities because they almost always have to be paid within the next year. We covered a lot of those topics earlier when we talked about adjusting entries and the gathering of financial information. So here in Chapter 13, we want to look at some of the other current liabilities that companies typically have to report. When we are looking at liabilities, it's important to realize that a liability typically has three characteristics. There must be a probable future sacrifice, and you will find that the word probable comes up a lot when we're discussing liabilities. That sacrifice is usually of an asset or service, some economic benefit. In addition, the liability has to be a present obligation, one that has been created by a past transaction. In other words, it is not a liability that is going to occur. It's a liability that has already taken place. So when you're judging whether something should be recognized as a liability, always make sure that you look for those three characteristics. Now I'm going to begin the coverage here with gift cards. Over the last 5 or 10 years, gift cards have become enormously popular. Almost every business is willing to sell you a gift card to allow you or somebody that you give the card to come back and get inventory or a service for free. This is a liability because the person who has the gift card has a claim to the company that sold the card. It does qualify as a liability, and if it's going to be redeemed within the next year, it qualifies as a current liability. How do you report gift cards? We like to use this as a way to discuss with students the recording of just basic liabilities that companies have to report. Well, a gift card, when it is bought, creates an unearned revenue. The company has the money, but it has not yet performed the service to turn that into a revenue. It is a liability. Why is it a liability? Because the company is obligated to either give the customer a product or to perform a service. There is work to be done. And as long as there's work to be done, the company has a liability. So when the gift card is acquired, the liability is recorded as an unearned revenue that shows up in the balance sheet under the liability section. You can look at balance sheets for many companies and see gift card liability or unearned revenue for gift cards. Then, once the card has been given, once the product has been delivered, once the service has been performed, that unearned revenue is reclassified as a revenue. Now there is a liability that is not paid with cash. It is satisfied by the performance of a service. But it is still a liability, and usually a current liability. In this chapter, we also talk about commitments. A commitment is an unexecuted contract. In other words, you've already established that you're going to have a liability, but it has not taken place yet. For example, if you call up on Monday and you set up a contract to buy some items on Friday when you show up, you have a contract, you have a commitment. But until you go to the store on Friday and buy the goods, you do not have a liability. From Monday, when you establish the contract, until Friday, when you actually do turn that in to a real liability, that is a commitment. Because that has a financial impact on a company. Commitments do have to be disclosed and explained. So if you look at a balance sheet and you see a commitment, that is the situation. Companies also typically have a great many contingencies. A contingency is where the outcome is uncertain. You have a great many of those in most companies. We typically talk about lawsuits, but warranties and other type of contingencies are also common. Now think for yourself about what this affects with the financial reporting. If the outcome is uncertain, how do you do the reporting? How do you report something that is uncertain? Well, the rules here were established decades ago according to U.S. GAAP. If you have a contingency, you must report it at the point in time when there is a probable loss. In other words, you're going to have to pay the money. It is probable. And you can make a reasonable estimation of the amount of that payment. Two things. Is it probable of the outcome? And can you make a reasonable estimation? So even though the payment may not be for years, at the first point that you can make those two, or answer those two questions, is it probable? Yes. Can you make a reasonable estimation? Yes. Then you have to recognize it at that point in time. Lawsuits, again, are a good example. It may take years for them to be resolved, but at the point that they're probable and at the point that you can make a reasonable estimation, you have to recognize the amount right then. I do want to mention, if you have a gain contingency, where you're going to get something, but the outcome is uncertain. Accounting is conservative, and gain contingencies are not reported until it is substantially complete. So here you're not consistent. Loss contingencies are recorded when the two criteria are met. Is it probable, and can you make a reasonable estimation? Gain contingencies are not recorded until substantially completed. Now the problem with contingencies is that they typically turn out to be different than the amount that you have recognized. When do you recognize, or how do you recognize that difference? For example, let's assume that you're being sued and you recognize $1 million as the loss and as the liability. But a year or two later, it turns out to be $1,100,000. What do you do with the other $100,000? In almost every case, the change that comes about when you know the real number is recognized when you discover what the real amount is. You fix it when you find it, is what I tell my students. So if in year one you recognize $1 million, but in year 3 it turns out to be $1,100,000, the extra $100,000 is recognized in year 3. Now I will make one exception to that. If the original amount was recognized and it was not made as a good faith estimation, in other words, the people were trying to manipulate the financial statements in some unethical way, then you go back to the original year 1 statements and you change them. We finished this chapter by looking at one type of liability that's really a contingency, and that is a warranty. Many companies sell products that have a warranty attached, so that if the product breaks, the company is responsible for fixing it. That is a liability where the outcome is uncertain. There are two types of warranties. One is called an embedded warranty. When you buy the product, you get the warranty automatically. In that situation, as soon as the sale is made, you estimate, if you can, what the warranty is going to be, and you recognize it right then. That's a good example of the matching principle. The revenue for the product is now, so the related expense from the warranty should also be recognized right now. But again, only if it is probable that some of the items will break and you can make a reasonable estimation of the amount. Then, when they break, the liability is removed and you pay to have the item fixed. Other warranties are called extended warranties because you pay for those. The store will allow you to pay a certain amount, and when you do that, the warranty is extended for some period of time. In this case, it's very much like a gift card. The company that sells the extended warranty does have a liability, and it is a contingency because the outcome is unknown. But in this case, it is recorded as unearned revenue because the customer has paid for this warranty. So therefore, the company has received money. There's a number of different types of current liabilities the companies must recognize. Here in this chapter, we want you to get used to the recording and the reporting of current liabilities, whether it's rent payable or salary payable, whether it's a gift card, a lawsuit, a warranty. All of these are very common. The more that you understand about them, the better able you will be to look at a set of financial statements and understand what you're seeing. Now, go read chapter 13, read all about current liabilities, and see if it doesn't make a lot more sense now that we've introduced it to you. Have fun, enjoy the reading.